Well, the regulators have been very clear that these are investor-led standards. So the information that's to be disclosed is going to be on a consistent and transparent nature, and it's going to allow organisations to disclose information on a like-for-like basis, which does provide that trust to users of financial information, whether they be investors, financiers, or other stakeholders.
Welcome to The Greener Way. I'm your host, Michelle Baltazar, Director of Media at FS Sustainability. We are recording on Gadigal land, and we pay our respects to the traditional custodians of country and elders past, present, and emerging. Today's episode is on so-called sustainability-related disclosures. We also have what's called the CRFDs, or the climate-related financial disclosures, and how that impacts companies. We're going to talk about what they are, what are the government rules about them, and by the end of this episode, we're also going to discuss why entities that may not necessarily be covered under these new government rules need to really watch out and monitor what's happening in this space. Now, some of you might think an episode around accounting disclosures is ho-hum, but there is so much drama happening in this space that it's beginning to look like an episode of the early 90s drama and thriller Melrose Place. For a start, Australia is among the big countries leading the charge, so all eyes are watching us and just waiting for us to trip, in fact. And in February this year, a major plot twist. The Trump government threatened to rescind the climate reporting requirements supported by the previous government, creating more angst and uncertainty. Now, in the middle of this fireball, excuse the hyperbole, are the accounting firms in Australia that must push on with local laws. So what's the deal? Joining me today is Nicholas Guest, co-lead of Mann Judd Sustainability Steering Committee, as well as an assurance and advisory partner in the Sydney firm. Now, for those of you who don't know HLB, it is an Australasian association of independent advisory and accounting firms with member firms in Australia, New Zealand, and Fiji. HLB was also ranked 7th in the 2024 Top 100 Global Most Loved Workplace list, which means that when they talk about sustainability, they are true to label, and this is truly part of their DNA. Nick, thank you for joining us.
Thanks, Michelle, and welcome.
Now, I'm sorry if I got carried away, but surely you agree that there's quite a lot of buzz around this new accounting disclosure because they just kicked off. And basically, a lot of small to large companies don't really know what they are. So forgive me if we have to kind of go back to the basics. But can you tell us, what are these new disclosure rules and which companies will be affected?
Michelle, the new disclosure regime came into effect from 1 January 2025 with the requirement for certain entities to disclose climate-related financial disclosure information. The Australian government during 2024 adopted legislation which is going to see Australia align with the international sustainability standards. So I think we're one of the first jurisdictions globally to implement these standards, which are aligned with our international accounting and financial reporting standards, which our disclosing entities currently adopt. And so from the reporting period starting this financial year or during 2025, the largest entities in the economy are going to start disclosing climate-related information for the first time. So that's a big change for many organisations. And then there's a phased approach, which over the next 3 years, we'll see gradually smaller entities needing to mandatory report climate-related financial information within their annual report. So a lot of mouthfuls there.
I know. The big thing, I guess, here is that it's important for a lot of people who do invest their money into sustainable businesses are rewarded, if you like, with transparency and proper reporting. And in many cases, some people feel like this is long overdue. But to be honest, I feel like there's mixed response around this. Some people think that this is essential, and some people think this is too much work, and we're already covering it in existing accounting standards. So what would you say to those kind of commentary?
Well, the regulators have been very clear that these are investor-led standards. So the information that's to be disclosed is going to be on a consistent and transparent nature, and it's going to allow organisations to disclose information on a like-for-like basis, which does provide that trust to users of financial information, whether they be investors, financiers, or other stakeholders. So yes, there is a disclosure and reporting burden necessary in preparing that information, but we'd like to think that there's value to organisations beyond just disclosure and stepping back and understanding why this climate-related information is being disclosed, and hopefully it helps the organisations create meaningful change around their climate targets and strategies beyond a pure compliance obligation.
And arguably, this shouldn't come as a surprise to many companies out there. We've been talking about this for the last few years. And in fact, some technology companies have emerged that hopefully can help handle what you call the admin burden, if you like. So what are your views in terms of the capability of a small company that's really stressed out about this? How can they track the numbers? How can they comply with the new rules?
Well, that's a very good point. And the information, or some of the information that is being disclosed or required to be disclosed under the standards, is not new. It's applying methodologies and frameworks which have been in place for many years. And in the largest entities, many have been disclosing voluntarily information over a period of time, but potentially on disparate frameworks. What the new standards require is the consistent reporting of that information under the one international reporting standards. Now, to the question of how do small entities get on board, absolutely, there's on-ramps for entities to utilise technology to help them efficiently and effectively collect data internally, and which is going to be useful for making decisions. And I think we're seeing a huge investment across the tech sector to come to market with platforms that are going to make it easier, or do make it easier, for smaller organisations to measure their baseline emissions, which then helps their leadership teams make decisions around strategy, around how they might take action to actually reduce their emissions in future periods.
So you mentioned that there is a three-phased approach to this. And in fact, there's the Group 1, Group 2, or Group 3 companies. For our listeners who are keen to hear a case study from you, how about we go to what is a Group 2 company, shall we say, and what does this mean for them?
So, Michelle, under the legislation, organisations are categorised, as you mentioned there, with Group 2 being the middle category, being an entity that has two of the three criteria being either over 250 employees, over $500 million in consolidated assets, or over $200 million in annual revenue. These entities are going to need to mandatory report climate-related information from the period starting from 1 July 2026. So for some of those entities, that's going to be they're 12 months to 18 months away. They're going to need to start putting into the market publicly climate-related information, which otherwise would most likely have for some of these entities not even been previously captured or reported internally. And the emissions data, being their physical data on their carbon impacts, is only one element of that information that needs to go to market. They also need to be able to disclose their governance. So what are they doing internally around their sustainability and climate-related strategy?
Mm-hmm.
They actually need to disclose information around their strategy. So what are they doing as an organisation to address the potential impacts of climate-related risks and opportunities on their organisation? And then how are they managing those risks? So what actions are they going to put in place to be able to manage those risks and opportunities in the future? And then there's some specific information about metrics and targets. So as you can understand, for some organisations, this is quite a new concept to be disclosing to market forward-looking information, which is not just financial related, but it's around the strategies of the organisation. And for some of these organisations, it's information around a climate strategy or a sustainability strategy, which may not yet be well formed within those entities.
Yes, and a lot of companies are probably worrying about their cash flow, their revenues, and now we're talking about their climate strategy and what it means. But can you walk us through, let's say it's July 1, 2026, what happens next? Do you or does the accounting firm work for 6 months with the business and then you spit out a sustainability report that's like 100 pages at the end? Or I know that I'm trying to kind of make light of it, but I know that it's a big deal. But how does that look like?
What we're seeing is that a number of organisations, and actually many organisations, have published sustainability reports currently, and some have well-formed broader sustainability strategies. What we need to communicate is that the specific requirements of this climate-related financial disclosures is breaking out from those reports specific obligations, and they may not have historically captured or reported on those specifics. The actual output, when it's going to be included within an annual report of an organisation, is going to be much less than the 100 pages. It's going to sit as a component of their annual financial statement. So at the moment, a set of annual financial statements produced by an organisation has a director's report. It may have a remuneration report, and then it's got the core financial statements. It's now going to have inserted within that climate-specific disclosures. As to the process of how an organisation is going to get there, I would put forward a position that if a Group 2 entity was waiting till 1 July 2026 in order to start their process, they've probably left it a little bit too late. Because as we know, sustainability often doesn't have one owner within an organisation. The responsibilities for sustainability sits across multiple key roles within an organisation, and it requires the collaboration across those roles in order to pull together the required data, strategies, and in some case scenario analysis, which can be quite complex, and again may not be the type of information an organisation has produced historically. So we're going to need inputs from the senior leadership team, the finance team, potentially procurement, engineering, public relations, the lot. So it's needing that collaborative approach across an organisation. So, and it may well involve external advisors as well, as you've pointed out. We're really encouraging organisations to start the process early.
Nick, thank you so much for your time. Now, before I let you go, I did say earlier that entities who don't fall under Group 1, Group 2, Group 3 need to do something about this as well. And secondly, you know that we cannot finish this episode without talking about what's happening in the US and the reversal of the climate policies there. If you can just share your views on that as well.
I'll start with the easy one first, and that's the entities are falling outside of the mandatory scope. And we've had some very meaningful conversations with organisations who see the commercial opportunity and also the commercial imperative for them to take action. And now their action is different to needing to prepare full disclosures or information that be aligned with the full disclosures that's required under the climate-related financial disclosures. With those organisations who are likely to be somewhere in someone's Group 3 supply chain, a starting point is just undertaking an initial baseline emissions measurement exercise and then using that data both internally to potentially look at opportunities to reduce their carbon, but also communicate that in a meaningful way to their stakeholders so that they can advance their commercial objectives. As to the US, I'd like to sort of avoid comment on political positions. We do need to recognise that there is volatility within the ESG and sustainability sectors, and the US is such a large market, an established market at the moment. Some of the commentary from in the politics in the US does have ripple-on impacts. And one of the things we are seeing is what we call the sort of the green hushing, where we're seeing some organisations de-emphasising some of the good work they are doing around sustainability and some of their ESG initiatives. Talking with some of our colleagues in the US, while we're seeing some I guess, standing back from positions that have been publicly disclosed previously, most of these organisations are still, staying the course. That they recognise the commercial imperative to continue to reduce the energy reliance within their businesses. They recognise that their sustainability positions that they had adopted were good for their organisation, and they're likely to be, continue to be good for their organisations commercially. So they may not be as vocal in communicating externally some of their current initiatives. They are still staying the course and undertaking the good work that they're doing there. If we look at that from the Australian context, most organisations now recognise that our growing energy requirements across the economy are going to be sourced from renewable energy. It's unlikely that the economic business cases will stack up for continued reliance on fossil fuel generation for new energy. So we are seeing the transition in the economy to reliance on renewable energies. And so organisations are going to follow that from pure economic standpoint. So we're seeing most organisations actually staying the course, putting in place good commercial practices which do align with good ESG frameworks. And that alignment of ESG with organisational strategy is critically important. And I think it just makes good commercial sense. So while the political ping pong might continue around policies and the like, I think fundamentally most organisations will continue on a sustainable journey.
Well said. Well, it looks like you've got your work cut out for you in the next 5 years, regardless of the Trump administration changing its climate policies. Nick, thank you so much for your time.
Thank you, Michelle.
This is The Greener Way. I'm your host, Michelle Baltazar. Thank you for listening.
The Greener Way podcast is a product of FS Sustainability. All information in this podcast is for education and entertainment purposes only. It is not intended as a substitute for professional, legal, or tax advice. Before making any financial decisions, you should read the product disclosure statement, and if necessary, consult a licensed financial professional. For more information, head to the disclaimer page on the FS Sustainability website, fssustainability.com.au.